Welcome to Chapter 4-2, which is on something called responsibility statements for a merchandising business that is organized with different departments. So in this lesson, we'll be talking about direct and indirect expenses and what those are for a departmentalized business. We're going to talk about preparing a departmental margin statement, and then we'll also do some calculating and analyzing of vertical analysis ratios. So first off, we have something new that we haven't heard of quite before, and it's called a responsibility accounting system. And there's a couple of important features um, to what a successful responsibility accounting system would look like. And in a successful one, each manager is assigned responsibility for only those revenues, costs, and expenses for which he or she can make decisions and affect the outcome of. So essentially what that means is that a manager that's in charge of a department is only going to be responsible or assigned the revenues, costs, and expenses associated with that specific department. And the other part of that is that the revenues, costs, and expenses for which a manager is responsible have to be readily identifiable within that manager's unit. And simply what that means is that we have things like sales for grills, sales for furniture, purchase returns for furniture, purchase returns for grills. So as it says here, if a manager is responsible for an advertising expense, that manager should then also make decisions about advertising. If a manager doesn't make decisions about that, it does not fall underneath their responsibility system, is essentially what they're saying. So, like I said, what that means is that in responsibility accounting, it traces revenue, costs, and expenses to an individual manager who is responsible for making decisions about those specific revenues, costs, and expenses. So when we talk about responsibility, technically the definition simply means is assigning control of revenue, costs, and expenses to a specific manager. And that's what responsibility accounting is. But again, in order for it to be successful, as I look back here, each manager is assigned those that they're responsible for, and then they have to be readily identifiable. So those are the two important things. Now, a typical merchandising business is going to have all of the normal end of fiscal period statements, particularly one that we are familiar with is the income statement. They have an income statement that's going to show the net income that's earned during a fiscal period. But typically with an income statement, it does not give specific information for department managers that they can use to help control their department costs. So therefore, typically what merchandising businesses do is they often prepare departmental statements to show each department's contribution to net income. So it's simply just breaking it down by departments. So when it comes to responsibility accounting, we have our operating expenses. Remember, those are the normal expenses used in operating a business. We break those down and we classify them as either direct or indirect expenses. And a direct expense is an operating expense that is identifiable with and chargeable to the operation of a specific department. So, for example, if you could take the cost of supplies that's used by the grill department, that's a direct expense. On the flip side of that, an operating expense that is chargeable to the overall business operations and is not readily identifiable with a specific department, we call that an indirect expense. And an example of that would be the cost of electricity for the entire building. We wouldn't be able to identify how much of that electricity was used by the grill department. So since the department manager of the grills has virtually no control over the cost of electricity, that wouldn't be included on their departmental margin statement because they have no control over it. So the only thing that goes on a departmental margin statement is what those managers of that department have control over. So remember, responsibility accounting is where we had revenue, costs, and expenses that were related directly to a department. A responsibility statement is a financial statement that reports those revenue costs and direct expenses under a specific department's control. So our company, our Wiley company, they prepare all of the usual end of fiscal period financial statements, but they also prepare responsibility statements for each of their departments, which are grills and furniture. So instead of calling it net income, what we do is we call it a departmental margin. And all that simply tells us is how much that department made. We look at its cost of merchandise sold less all of its direct expenses. And so that statement that we're going to make in this unit is called a departmental margin statement. Now, where does this information come from to make our departmental margin statements? We're going to look at one specifically for the grill department for Wiley on the next slide. The information comes from your adjusted trial balance and the accounts that have grills in their account title. So whatever department you're making your departmental margin statement for, if it's grills, if it's furniture, if it's kitchen, if it's bath, whatever it happens to be, you just look for the account titles that have that specific department in the account title. You're going to notice that the format is very similar to the income statement, so that should be helpful for you. However, the thing to note is that it's only direct expenses that go on the departmental margin statement. We do not care about indirect expenses. We only care about the ones related specifically to that department. So again, if it has grills in the title, that would be one that we would include. So if we look over here, here's an example of one. We start out with sales, and again, these would be sales only for grills. But since it says the departmental margin statement is for grills, we don't have to say sale grills, sales discount grills, sales return and allowances grills, merchandise inventory grills. All of this we are assuming has to do with grills since it's a departmental margin statement for grills. So you can see we do sales. We take out any sales discounts and returns and allowances that we had, and then we subtract those two to get our net sales. Then we start with our merchandise inventory. In the beginning of the year, we get our purchases. Of course, we need to get down to net purchases, so we subtract out any of the things that we either got discounts on or did purchase returns and allowances, and that will give us our net purchases. So we have the merchandise that we started with for grills plus the purchases that we made during the year, and that gives us our total cost of merchandise available for sale. Then we take out whatever we had left at the end of the year or ending inventory for grills, and that will give us our cost of merchandise sold as seen here. To find our gross profit, and remember gross profit is the operating revenue remaining after cost of merchandise sold has been deducted. So what we do here is we take our net sales and subtract out cost of merchandise sold, and that will give us gross profit. Gross profit again is going to show the direct relationship between sales and the sales price and merchandise inventory and the cost of merchandise inventory. So it's a really important number for us to know. And then, of course, we have our direct expenses. Again, these are only the ones that are associated with the grills department. So it's advertising expense, grills, payroll taxes, grills, salaries, grills. And we add all those up and we subtract those directly from our gross profit, and that gives us our departmental margin. Now remember, that is the income that was made by our grill department. We don't call it net income, we call it a departmental margin. So that's what you need to know. Also notice, and I'm going to talk about this in the next few slides, that we do a vertical analysis on a departmental margin statement. So we'll talk about that right here. Obviously, we want to do some analyzing of our information because that's what helps managers make better decisions. So of course, a comparison between two components is a financial ratio. And since we're going vertically, we call it a vertical analysis. So remember that everything comes from net sales typically. So net sales is always at 100%. So if you take the departmental margin divided by net sales, it's going to give you your vertical analysis ratio for departmental margin. We end up doing it for so we're going to do it, we do it on all four of those. Now, a business may set departmental margin goals to encourage departments to try to maintain acceptable performance. They are based on a number of different factors, including how did the department do the previous year, what kind of economic and market trends are happening at the present moment, and then also any changes that might be happening in the department's costs. Um, the vertical analysis ratios for the current fiscal period also get compared to last year's. And so they do this every year. And what the managers are looking for is any changes that are happening. And if the change is positive, then typically whatever is being done continues on. Those policies are continued. And if the changes are negative, then usually the manager will try to seek to make policy changes to try to help prevent any further declines. If you look at page 110 on your book, they do go into a little bit more detail about some of the specific ratios we were looking at. Again, like I said, the departmental margin ratio, cost of merchandise sold ratio, direct expenses ratio, and some of the factors that might affect some of those. So you might want to take a little look see at that. It could make an appearance on the test, so you might just want to read through page number 110 in your book. So you can head on over. We're going to do a departmental margin statement, two of them actually, um, for our business, and I'll meet you over there.